This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices a little bit lower in what appears to be a buy the rumor, sell the fact situation now that we do have a resolution to the financial problems in Washington. Although I would have to say that this is only a partial solution, since we will be addressing these issues in a not too distant future. We do have a new debt ceiling that will be imposed for February 7th. So over the near term, I think we may see a little pressure developing as the good news is now out of the way, so to speak. However, in the longer term, we do have the Fed's ongoing quantitative easing program, where they buy a total of $85 billion in treasuries and mortgage-backed securities every month. That has been the sustaining force for the historic gains that we have seen in stock index futures. That is likely to remain in place for quite some time. Do not expect the Fed to taper their quantitative easing program this year. The talk now is that they may taper in the first several months of next year. My feeling is that it will probably even be longer than that, maybe the second quarter. So expect QE to remain longer than many analysts are anticipating, and that is a long-term bullish factor for the stock indices. Over in the currencies, we're seeing the pound higher after UK retail sales coming in much better than expected. But it does look like the one currency that has the most fundamentals and technicals lined up against it is the US dollar. If we're right in thinking that the Fed's QE will be extended, that will put downward pressure on short-term interest rates and will continue to weaken the US dollar in the long term. We're already seeing a lot of pressure today in the greenback. So this trend is likely to continue, and of all of the financial markets that we are looking at, it's the dollar that has the most fundamentals and technicals aligned against it currently. In the treasuries, we are seeing futures higher. An extended QE program, of course, is bullish for treasuries if the Fed continues to come in for a long period of time buying assets. So I think I'd stand aside for now in treasuries. There are too many cross currents, but instead I would focus on currencies, specifically the short side of the US dollar. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.